Hello guys, I hope you all are doing well, enjoying the course so far. If you have any questions, please do ask in the comment, so I'll try to answer as much as possible. Okay, let's jump into the next phase, which is kind of little bit advanced than the basic phase, but you need to understand the things that in order to have fully understanding of the strategy and how it works, right? Yeah. So what we're going to talk about today is like about an order flow and mitigation, and how to mark order flow on the chart. Okay, so it will help you to understand why the price move the way it is. Okay, so if you I hope you know you're watching the materials from the very first video. If you, this will not make sense if you don't know what is an order block, what is a mitigation and the stuff, right? Okay, so I highly suggest go back to my playlist of order block strategy. In the right corner, click here and start from the beginning and then come back here. It will make more sense to you when you have all this the knowledge of the terminology that I talked about earlier, right? Okay, so let's, without further ado, let's start into it. Okay, so what is an order flow and mitigation? So let's talk about the mitigation first. Okay, so I talked about in the very first video, but I will just summarize it. Okay, what is in mitigation? So mitigation is like when institutions when they want to, let's say they want to push the price down. Before pushing a down price, they will do like this, up and then push down. So they will sacrifice some positions here, some money here, in order to get liquidity, or some people stops, the stop orders, stop losses, breakout traders money, and then the price will go down. They will sacrifice these positions in order to get those liquidity out and the stuff, and then they will move in the desired direction they wanted to move. Okay, so in this strategy we are trading the footprints of their actions. Okay, so that's how. Okay, they don't use this the stop losses. The big funds and they don't, because they have a lot of access to the capital. They don't need to use stop losses like retail traders like us. Okay, so in order to when they sacrifice these positions in order to make their losses minimum, they will come back to this position here to mitigate their orders and minimize the losses, and then they will move down. Okay, so that's the term where it comes from, the mitigation terms for. They will generally simply minimizing their losses before it going again down. Okay, so that's a mitigation. Okay, so order flow is nothing but just the following the mitigation of mitigations. Okay, so order flow is mitigation is order flow. It's one and same thing. Okay, so it's different from the breakup structure. Okay, sometimes you will see the structures are breaking, but mitigation is not being followed. Okay, I will talk about what is it. Okay, but I hope you understand what is mitigation. So order flow is nothing but a mitigation of the orders that institutions sacrifice before. Okay, so let's talk about this example, and then how I marked it and how you can mark it. Okay, the order flow, right? Okay, let's talk about it now. So this is an euro and US dollar chart. You can use it on any chart. Okay, any stock market, any other currency pair, anything, cryptos and the stuff. Okay, so you know what is lows, solidified lows and highs, and how to mark it. I just marked it. Okay, here. Okay, so this is a low and this is the last high it made. Okay, so what do you see here? Okay, so if you see this low is been broken here, okay, so it makes a new low, so this will be a new low, and the high, you can say the high is here, okay, not here. So if you don't know how to mark highs and low, it's not simple, okay, it just looks like a simple. If you make a mistake marking highs and low, everything will fall apart. So you will not know why your trades are failing, okay. So you need to do you need to mark those stops very accurately, because we are talking about here a stop loss of a couple of pips, 2 pips, 3 pips. So you need to be accurate, otherwise this strategy will not work, okay. Marking highs and low, very important. So okay, so now we marked highs and low, so we need to mark order block. So if you see, this low was a previous low which was broken here, right? And who broke that low? The structure. So this, okay, this last bullish candle before bearish move, so the order block. So this is up move before going down, so that's an order block, okay. So if you don't know what is an order block, go back to my very first videos, okay. So the price will come back to this order block to mitigate the institutional's loss before it again break the new structure. So this is a mitigation of their orders before you have the full move again, new break of structure, okay. The BOS is break of structure. So you can say that order is mitigated here and created new low. Price has no reason to come back again and violate this high, because the losses they had made is already been recovered. It doesn't they doesn't have any reason to go up again, right? So this is how it looks, okay. So the mitigation, new break of structure. Now who causes this break of structure? So this is an order block. So the price will again come back to this place to mitigate their orders, and then before it moves down, right? So now, and this is what exactly happened. Price will come back to this order block, and then we will have this new break of structure here, okay. Now, so again, next break of structure. So this is an order block for next break of structures, but price didn't come to this order block. Price just mitigate something here. I will show you what is there, and then it from a new break of structure, right? So you need to mark mitigation like this, right? So you might say, okay, why the price didn't come to this order block before it comes down to the new low, okay. So we'll talk about types of order flow, strong order flow and weak order flow in coming topics, coming days, okay. But just remember, price may mitigate order block or this price inefficiency, 50% of this, right? So but if you dissect here in the lower time frame, if you go back to lower time frame and see what is there might be something here, a buy candle, last buy candle before this break of structure, okay. So price may mitigate there and you form the new break of structure. Yeah, got it. Same thing is here, okay. So price is mitigated. Okay, I'll show you what I mean, okay. Let's go back here, okay, and see what is there. You see, if you go to the lower time frame, you see this a little green candle. This is where price is reacting from. So actual break of structure was happen from here. So that's where it is mitigated. It doesn't mean this is not valid. If you are waiting for this order block to come, this order block to come here and then have your trade, that's okay. You can miss this trade, it's okay. Okay, you can have a plan like, okay, I will only trade the order blocks, not the price inefficiency. It's fine, it will work, okay. But in this case, you don't be having a trade, okay. So for example, now again, new break of structure mitigated something, price inefficiency here, and then new break of structure, okay. this breakup structure happen here, and this week you see here, and this week it has an order block here, right? So it mitigated those orders again from a new breakup structure. So this is the way you follow it. Okay, follow the order flow, and that's is nothing but the order flow. Okay, so it's a simple order flow. Nothing but mitigations of the order, right? So it will be very helpful while understanding, while taking an entries on the lower time frame, right? So if you follow the order flow, why order flow is important? Because just above that order flow you have point of invalidation. We'll talk about in coming videos what is point of invalidation and stuff. Okay, that will give you absolute certainty that okay, if the price comes above this, we are wrong in the direction and changing the direction, possibly changing the direction. Okay, so that is it about the this thing. Okay, so how to mark it, that I already showed how to mark it, right? So you need to mark breakup structure, order block, and mitigation. So let's say you come into the morning and see, okay, oh, you don't have the so you have this order block and it's not mitigated, and you have new breakup structure. In this case, price may come back here before come down, because it has a reason to come back here, right? This order block, this loss of institutions' money is not mitigated, so it has a reason to come back there before it goes down. So that's why I will highly suggest, okay, don't trade this price inefficiency thing, go with the only order block like this. Okay, so you will get a chance in a big swing like this. So this is an order block, mitigation, breakup structure. That is huge move. Just a couple of pip stop, you will be doubling your account here. Okay, on the moves like this. So you try to follow the order flow and mitigation. So yeah, so I will just finally repeat the what is in a nutshell. So oh my god, so we have this kind of structure. Okay, new breakup structure, mitigation, breakup structure, and this is an order flow. Okay, so you just follow the mitigation, and that's order flow. So you need to, when you mark your structure, you need to mark the last point of mitigation, right? And that will help you to avoid to take trade like this. Okay, so taking from here, because you never know, you just come here and it will come again back here, because it has a reason to come up, right? So that is it about order flow and how to mark it on the chart. So what we're gonna talk in the next video, the types of order flow, weak order flow, strong order flow, and how to identify them, and which one is better for your taking a trade based on the order flow. Okay, and then we'll talk about the point of invalidation in the next video. All right, see you again.